Horrific Netflix earnings rang alarm bells for media stocks. I own one of them, and we saw a big options trade in the name today. A viewer question on Home Depot and another on adjusting diagonal spreads in O'Reilly Automotive after the company's rare earnings miss. All that on today's Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and this is Open Interest. Many of you are aware that Netflix posted its worst post-earnings performance after falling over 35% the day after reporting, and that company hit a new 52-week low today and is now down over 70% year-to-date. Disney will be reporting tomorrow, and the options market is implying a greater than 9% move by week's end. The streaming story, which had propelled it out of the pandemic lows, more recently became a boat anchor. Disney is essentially unchanged since April of 2015. An opportunity? We'll find out tomorrow. But in the meantime, Viacom, which renamed itself Paramount, ticker PARA, and AT&T have been trying to navigate the streaming wars themselves. Both of these companies look at first blush to be quite cheap, and I own one of them, Warner Brothers Discovery, ticker WBD, which I received as a shareholder in AT&T, which I recently purchased. When they spun it off, today we saw a purchase of 8,750 January 2023 22.5 strike calls in WBD, well out of the money as that stock closed at $17.36 a share, more than 30% lower than where the shares began trading after that spinoff. There's no getting around the fact that Netflix's surprising subscriber loss has many investors questioning their growth models for other companies that have indicated they want to invest in streaming, and it's clear that visibility through the end of this year and possibly next is very poor at this point. That said, it's worth noting that Warner Brothers is likely generating between $1.50 and $2 a share. And even at the lower end of that range, Warner's trading about 13 times EPS or less, with probably $3.5 billion of full-year free cash flow. It's in situations like these that a long-dated call purchase, like the one we saw today in those January 22.5s, makes sense. The market is shaky, and this stock is shakier. Timing a potential rebound is all but impossible, but purchasing longer dated calls is a mechanism to get some upside exposure with limited risk. And in this case, the buyer is risking less than 10% of the stock price over the next 7+ months or so. This is not inconsiderable given the 22.5 strike is well out of the money, but given that the stock is down 30+% since it was listed, one can begin to understand why this might be a more tentative way to play it. I don't happen to own the January calls, but I did add a bit to my long stock position today. So this brings me to our question on Home Depot. Vitali asks, at Mike, with Home Depot down substantially, do I sell the calls that you recommended on last Friday's options action, or do I hold on to them? Thank you. Okay, so those calls are essentially unchanged. I know, I own them. However, the market is going through some pretty significant gyrations. Look, the logic of purchasing calls rather than the stock in this case was recognizing the risk that the current market presents. Will the stock fall further? I don't know. Does the valuation make some sense to me here? It does. Sub 20 multiples for Home Depot don't come around too often, and we're risking less than 10% of the current stock price for a call that's only just barely out of the money. So that's our worst case loss. Now, if you're concerned about decay, you can consider selling some shorter dated out of the money upside calls against it, such as the June 330 calls. Because the net debit between owning the January 300s and selling the June 330s would be less than $25, which in turn is less than the difference between those two strikes, there's no risk of loss to the upside if Home Depot rallies sharply. It would reduce the worst case downside loss to $24, and it would also offset any decay on a standstill basis. However, if you have a strong belief that the market has a lot more downside, few stocks are likely to really perform well, including Home Depot. So maintain some dry powder, meaning don't spend all of your capital buying long calls hoping for a rebound, but tactically, I am purchasing some. Okay, so that brings us to our last question, which is in many ways related. M. McCann asks, Mike, can you discuss adjusting a long-dated vertical calendar? 2 months ago, I bought a Nove O'Reilly Automotive 500 strike call and sold an April 700 against it. ORLY moved up, so I rolled the 500 to the 600s and then rolled the April short to a May 750. ORLY was just crushed in earnings. Question: can you please discuss strategies for handling similar situations? Obviously, I can close both, exiting the trade entirely. I did receive $17 for the May 750s and got $7,000 for rolling the 500s to the 600s. What now? 1x2, look for a longer dated out of the money call to sell against the 600. Thanks in advance. Okay, so typically I refer to purchasing longer dated at or in the money options against selling shorter dated further out of the money options as a diagonal spread. This is a trade I really like because it gives some protection if a stock moves against my directional thesis, and the shorter dated options offset some or even all of the decay. This type of position is sometimes called a poor man's buy right when we're talking about call spreads, where a longer dated call substitutes for a long stock position. I don't think of them this way because typically they don't move as much as a buy right would, because the long calls, if they're at the money, will only move about 50% as much as the stock will. And once a short call is added, it'll move even less. However, in your case, you owned the 500 strike calls when the stock was substantially higher than that. And even when you rolled them up to the 600s, they were still deep in the money. So the good news about a position like that is that those calls will in fact behave more like stock than at the money calls would. The bad news, as you learned, is that they will behave more like stock than at the money calls would. So that works in both directions. So when O'Reilly posted a rare earnings miss, the protection of owning a call rather than the stock didn't help as much because they were so deep in the money and behaved essentially just like stock. For this reason, I generally do not use deep calls myself as proxies for long stock positions. That said, I know many people that I respect a lot do. In any case, what was a deep diagonal for you is now essentially an at-the-money diagonal. So the first thing I would do is cover those short May 750 calls, which you can buy back for almost nothing. So those were all profit. And then I would roll those out to a June strike that offsets the decay of the longer dated position. An example of those would be the June 670s. Now, I don't like to sell options for less than 1% of the strike, and that's approximately where those are trading. But also, I don't like diagonals that can lose if the directional bet, which in this case is a bullish one, proves correct, but the stock moves too far. So ensure the effective net debit is less than the difference between the strikes. And in this case, the net debit, which is how much it would be worth if you put the whole trade on today at about $60, would be less than the difference between the strikes. So that's all I have for you guys today. Don't forget, like the video, give us a thumbs up, subscribe, and hit the notification bell, and I'll see you next time. Thanks for watching.